Imagine for a moment that you've done everything right. You've spent the better part of 2 decades building equity, navigating the volatility of the 2008 crash, and surviving the post-pandemic rate hikes. You've found the perfect exit, a multi-million-dollar property sale that represents your transition into a more liquid retirement. The contracts are signed. The boxes are packed. The movers are scheduled. Then, on the morning of the closing, you receive a short, cryptic email from your escrow officer. The system is down. Not just their email, but the entire infrastructure required to verify the wire transfer and record the deed. You check the news expecting a market crash, but the Dow is up. You look for a local disaster, but the sun is shining. The value of your home hasn't moved a cent, yet your $2 million in equity is suddenly as inaccessible as if it were locked in a safe at the bottom of the Atlantic. This is the new reality of real estate, the frozen closing. It is a scenario where your wealth remains intact on paper, but becomes functionally non-existent due to a server error message. We have entered an era where the liquidity of your most significant asset is no longer determined by the market, but by the uptime of a handful of centralized tech vendors. I am the horizon, and today, we look beyond the headlines to analyze why the plumbing of our property markets has become our greatest systemic risk. To understand where we are going, we must acknowledge the end of the software-only era. Between 2010 and 2020, capital flooded into light assets, SaaS companies, social media platforms, and digital currencies that required very little in terms of physical overhead. This led to a sort of intellectual laziness in the markets. We forgot that every bit of data processed is a physical event occurring in a physical location. Starting around 2021, the world hit a wall. Supply chain disruptions were the first tremor, but the second was more profound. The realization that our digital ambitions have outpaced our electrical reality. The surge in demand for high-performance computing, driven first by the maturation of decentralized networks and then by the explosion of generative AI, has turned energy from a background utility into the primary constraint of capital. We have shifted from a world of speculative code to a world of physical constraints. If the last 20 years were about who could write the best algorithm, the next 20 will be about who owns the electrons required to run them. We are moving past digital gold toward what I call thermodynamic sovereignty. In the early 2000s, the landscape changed. Under the banner of national security and the war on terror, the regulatory burden on financial institutions exploded. Banks were no longer just service providers. They were deputized as the front line of global policing. This created a massive problem for the industry. A human-centric compliance model, where people actually reviewed suspicious activity, became too expensive and too slow for the sheer volume of digital transactions. The solution? Instant compliance. Financial institutions offloaded their risk management to artificial intelligence. They traded the rule of law for the rule of code. We have entered an era of proactive algorithmic policing. In the old world, the bank reacted to a crime that had been committed. In the new world, the algorithm attempts to predict a crime that might happen. For the investor over 40, this is the most significant shift in counterparty risk of our lifetime. The banks have calculated that it is far cheaper to false positive freeze 10,000 innocent customers than to let one atypical transaction slip through and face a multi-billion-dollar regulatory fine. They have successfully shifted the risk of their business onto your shoulders. When the algorithm flags you, the bank doesn't see a loyal customer of 20 years. It sees a data point that threatens their quarterly compliance report. This is why the freeze is now instant, automated, and most importantly, proactive. The mechanism driving this merger is the convergence of artificial intelligence and proof-of-work mining. At first glance, they seem like disparate industries. One is a decentralized ledger. The other is a centralized cognitive engine. But from the perspective of the power grid, they are identical. They are both energy-to-value converters. Large language models and Bitcoin mining rigs both perform the same fundamental task. They ingest raw electricity and output a digital commodity that the market prizes, intelligence in the case of AI, and truth in the case of Bitcoin. This creates a global floor price for the kilowatt hour. If a power producer can sell their electricity to a local data center to mint a digital asset or train a model for a higher margin than selling it to the residential grid, the price of energy will adjust globally. This is compute energy arbitrage. We are no longer just trading stocks or bonds. We are trading the efficiency with which we can transform heat into information. For the man over 40 looking to preserve his legacy, understanding this convergence is critical. You are no longer investing in a tech company. You are investing in a vertically integrated energy compute stack. What makes this particularly insidious is the lack of geographical escape. While we often think of risk as something happening in volatile emerging markets, the algorithmic lien is most prevalent in the most developed nations. The G7 banking systems are the ones most deeply integrated with these automated compliance engines. This means that the more secure the jurisdiction feels, the more likely you are to encounter a technical system that values instant compliance over your personal liquidity. We are seeing a convergence of banking standards globally through the Basel Accords and the Financial Action Task Force. This creates a monolithic code web. If an algorithm in London flags your activity, it is increasingly likely that your accounts in New York or Frankfurt will reflect that same risk profile within milliseconds. The frictionless nature of modern finance, which we've been taught to celebrate for its convenience, is the very same architecture that allows for a globalized, automated lockdown of assets. For the mature investor, the goal is no longer just finding the highest yield. It is finding the jurisdiction that still respects the friction of the law. We must begin to look at our assets through the lens of sovereignty, the ability to move, use, and deploy capital without a machine's permission. If your entire net worth exists within this code web, you do not truly own your wealth. You are merely a tenant in a system that can change the locks without notice. Section 5 takes us into the heart of the modern financial labyrinth, the erosion of due process. For those of us who grew up in the late 20th century, the concept of a lien or a freeze was inextricably tied to a courtroom. It was a visible, contestable legal action. If a bank wanted to halt your capital, they needed a reason that could withstand the scrutiny of a human judge. Today, that framework has been replaced by what we might call the black box. When an algorithm flags your account, perhaps because of a sudden cross-border transfer for a legitimate business opportunity or a change in your spending patterns, you aren't served with papers. You are served with a frozen screen. The nightmare of the algorithmic lien isn't just the loss of access. It's the total absence of a point of contact. When you call the bank, you'll find that the frontline staff are just as locked out of the decision-making process as you are. They see a status flag they cannot override. The machine has spoken, and because the bank's primary incentive is to avoid multi-billion-dollar regulatory fines, they will always side with the machine's caution over your convenience. We have moved into a state of presumptive guilt, where your liquidity is held hostage by a line of code that no one in the building can actually explain. For the investor over 40, this is a fundamental betrayal of the social contract we thought we signed when we opened our accounts. This brings us to the economic consequences. We often talk about the velocity of capital as an abstract economic metric, but in the real world, velocity is the difference between a successful acquisition and a failed contract. If you are moving mid-6 or 7 figures for a real estate closing, you are operating at the speed of the market. However, the software controlling your liquidity is operating on a different clock, one calibrated for maximum risk aversion, not commercial efficiency. Consider the compounding effect of these minor disruptions. When a 48-hour hold is placed on your operational capital, it doesn't just delay one transaction. It can trigger a cascade of broken promises, missed margin calls, forfeited deposits, or damaged relationships with vendors. In the 40-plus demographic, where we are often managing complex portfolios with multiple moving parts, these algorithmic friction points act as a silent tax on our wealth. We are seeing a divergence where the digital systems designed to secure our money are actually the primary threat to the velocity, and therefore the growth of that money. The machine doesn't care about your internal rate of return or your reputation. It only cares about its own risk mitigation parameters. If those parameters don't include your right to timely liquidity, you are, for all intents and purposes, no longer in full control of your assets. So how do we respond? The goal is not to abandon our values or to become digital extroverts. Rather, we must focus on engineering legibility. This is the strategic process of translating your reputation capital into a format that the new digital gatekeepers can ingest and validate. It requires a sober assessment of your data hygiene. First, we must begin to standardize our asset reporting. This means moving away from opaque, idiosyncratic accounting and toward frameworks that align with modern fintech protocols. It may feel like a concession to the machine, but in reality, it is an act of preservation. Second, we must bridge the gap between our private networks and digital proof. This involves utilizing blockchain-based verification for private contracts or ensuring that legacy holdings are registered in ways that are accessible to automated verification systems. We are not looking for quick gains here. We are looking for long-term sustainability. By making our assets legible, we remove the friction that currently exists between us and the global credit markets. We aren't changing who we are. We are simply ensuring that the language we speak, the language of reliability and character, is translated into the code that now governs the world's wealth. It is about maintaining the soul of relationship banking while adopting the skeleton of digital finance. As we close this deep dive, let's look at the horizon. We are entering a new social contract. The old world of due process and human discretion is fading, replaced by a technical system of instant, automated compliance. This isn't necessarily a conspiracy. It is the logical outcome of a financial system trying to manage infinite complexity with limited human resources. But for you, the investor, the educator, the provider, the cost of this efficiency is your autonomy. To thrive in this environment, you must be more than just wealthy. You must be intellectually honest about where your money actually lies. If your net worth is entirely dependent on the permission of a machine, you are a tenant, not an owner. The Horizons perspective is this: technology is a tool, not a master. By understanding the mechanism of the algorithmic lien, you take the first step toward neutralizing its power. Stay diversified, stay vigilant, and remember that in an automated world, your greatest asset is the sovereignty of your own mind and the strategic placement of your capital. This is a marathon, not a sprint, and protecting your legacy requires a sober assessment of the tools used to control it. Thank you for your time.